Have you ever deposited money into a bank and wondered what happens to it? Where does your money go? Does the bank just keep it in its vault until you need it? Actually, the answer is much more fascinating and has a huge impact on our economy. Fractional reserve banking is the foundation of modern financial systems. It's a system where banks hold a fraction of deposits as reserves and lend out the rest. It fuels economic growth by enabling lending and investment, and it also plays a key role in how money is created within the economy. So it's a very detailed and multifunctional thing. Now let's go over. What does it actually mean? Fractional reserve banking is a system where banks are required to keep only a small portion of deposits as cash reserve and can lend out the rest. The fraction held in reserve is mandated by central banks, for example the Federal Reserve or the European Central Bank, and that percentage is the reserve ratio, the percentage of deposits that the bank must keep in reserve. That is the reserve ratio. For example, if the reserve ratio is 10%, for every $100 deposited, the bank keeps $10 and can lend only $90. The cash or central bank deposits held by the bank to meet the withdrawal demands. So this is for security. So when a lot of people want to withdraw their money, make sure that the bank has enough money to meet those withdrawal demands, so it's for safety and it's also very important. The money lent out by the bank will generate interest income. But why it is used? It allows banks to efficiently allocate money to those who need it for investments or spending, and it facilitates the creation of credit, which drives economic activity. So let's see how the fractional reserve banking works. For example, if a customer deposits $1,000 into their bank account, the bank is required to keep 10% of these deposits as reserve, which is $100. And then the remaining $900 is available to lend out. The bank lends the $900 to a borrower. The borrower might use it to buy something or pay someone. The recipient of this $900 deposits into their own bank. The second bank now keeps 10% of the $900, so $90 as reserves, and lends out the remaining $810. And this process repeats across the banking system, multiplying the initial deposits many times. So it has a money multiplier effect. The total money created can be calculated by dividing the initial deposit by the reserve ratio. For example, with a 10% reserve ratio, the initial $1,000 deposit can generate up to $10,000 in total money. Banks don't just store money, they actively multiply it through lending, contributing to the overall money supply. And it also promotes economic growth, so by lending money, banks enable businesses to invest in new projects, hire workers, and expand operations. Consumers can access credit to buy homes, cars, or fund education. And deposits that would otherwise sit idle are used to fuel productive activities, balances liquidity, cash availability, and lending. So it's really efficient. And it also supports monetary policy, so central banks can influence the economy by adjusting reserve ratios or interest rates. So monetary policy is really just the central bank's influence in the economy, and reserve ratio is one of those tools. And now let's see what risk and critics the fractional reserve banking has. Liquidity risk. Banks rely on the assumption that not all depositors will withdraw their money at the same time. If too many people try to withdraw at once, this is called a bank run, the bank may run out of cash. It happened already a lot of times in economic crises. And during economic downturns, loan defaults can lead to a collapse of confidence in banks. For example, the 2008 financial crisis, where risky lending practices played a significant role, and excessive credit creation can lead to inflation or speculative bubbles, for example housing market bubbles. And the lending beyond prudent levels risks systematic failures also. And also moral hazard, so critics argue that banks may take excessive risk knowing that they are likely to be bailed out by the governments. So in conclusion, fractional reserve banking is a really double-edged sword. It has both positive and negative sides as well. On one hand, it drives growth and innovation. On the other hand, it can contribute to financial instability if not carefully managed. So the next time you deposit money into the bank, remember that it's not just sitting there. It's out in the economy helping others build their dreams. But how secure does that make you feel? Let us know in the comments. And if you enjoyed this video, then thank you very much for watching. And if you care about finance topics like this, I actually have a free finance community and course, and you can join that in the description. So thank you very much for watching this video.